In this session, we're going to discuss some of the rules that we will use to make capital investment decisions. In fact, we're going to work through some specific examples. What you should get is understand how to determine the relevant cash flows for various types of capital investments, to compute depreciation expense for tax purposes, to incorporate inflation into capital budgeting, understand various methods for computing operating cash flow, and apply the equivalent annual cost approach. Chapter is outlined as you can see in your book. First point, cash flow matters, not accounting earnings. Sunk costs don't matter. We're going to go through each one of these in detail, but sunk costs do not matter. Incremental cash flows matter. Opportunity costs matter. Side effects like cannibalism and erosion matter. And taxes matter. We want incremental after-tax cash flows. And inflation matters. So cash flows, not accounting. The big problem with accounting is depreciation expense. You never actually write a check for depreciation, and yet it's deducted from your sales, from your revenue figure in calculating net income. So much of the work in evaluating a project lies in taking the accounting numbers and reversing some of these non-cash entries to get cash flows. Incremental cash flows, first big one is sunk costs. A sunk cost is a cost that's already been paid. It's not part of the decision process. Just because we've come this far doesn't mean that we should continue to throw good money after bad. Now, opportunity costs, everything has opportunity costs, and they do matter. So just because a project has a positive net present value doesn't mean that it should automatically be accepted. And in particular, if we're choosing between projects and another project has a higher net present value and it would have to be passed up in order to accept this project, then we shouldn't proceed. We should charge this project with the cost of the missed opportunity. Side effects, erosion and cannibalism. Now, erosion means that because we've started a product, it's going to, and cannibalism really the same thing, mean that a new product is going to take sales or revenue away from an existing product. And the point is this. If you're going to lose the sales anyway, then they're not relevant. But if starting a new project is going to cause you to lose sales, then that's an erosion or a cannibalism effect, and it is relevant. Synergies are just the opposite. Hot dog buns and hot dogs. Whoever invented hot dog buns discovered that they could sell more hot dogs, or vice versa. Now, as far as estimating cash flows, we're going to be interested in cash flow from operations, and later on we'll talk about 3 different ways of calculating it. But for right now, operating cash flow is equal to earnings before interest and taxes, minus taxes, and plus depreciation. We're adding back the non-cash expense. Net capital spending, we don't want to forget salvage value. And changes in net working capital are another important consideration when we're calculating cash flows. Interest expenses. Right now, we're just going to sort of assume that we have no interest expenses, but the relevant point is this. When we're doing capital budgeting analysis, we want to separate the investment and the financing decision, and usually the investment decision has to do with debt, and that has to do with interest expense. So we don't want interest expense in our evaluation. Now we're going to look at a specific example, and this example is in your book, and I would recommend that you go over it very carefully. This is sort of the quintessential example, and you need to understand each and every item and exactly where it comes from. So this is the Baldwin Company, and let's just go over the basic assumptions here. The cost of test marketing, which has already been spent, is $250,000. Now, because it's already been spent, it's a sunk cost. And remember, we said sunk costs don't matter. Excuse me. The current market value of the proposed factory site, which we already own, is $150,000. Now, you may be thinking, well, since we already own it, the $150,000 value is irrelevant. But the point is this. By taking the project, we're committing the factory. And if we didn't commit the factory, we could sell it and raise the $150,000 cash. So the opportunity cost here, remember, opportunity costs matter. The opportunity cost is $150,000, and that needs to be charged to this project. Cost of a bowling machine. This is just the cost of our manufacturing equipment. It's $100,000, and it will be depreciated according to the modified accelerated cost recovery system. It is classified as 5-year equipment, which means we'll take depreciation, accelerated depreciation over 6 years. Increase in net working capital is $10,000, and the $10,000 will be released at the end of the project. And production. Now these are estimates, probably came from our marketing department. For 5 years, the life of the project, $5,000 in the first year, $8,000 the second, $12,000 the third, $10,000 the fourth, and $6,000 the fifth year. The price during the first year is $20. That is the price of a bowling ball, I guess. And the price increases by 2% per year thereafter. Production costs during the first year are $10 a unit and increase by 10% a year thereafter. There's a 5% annual inflation rate, and working capital initially will be $10,000, and it'll change with sales. Now what that means is, as sales go up, we'll add more working capital, and as sales go down, we'll reduce working capital. But the point is, on the working capital line, it should add up to zero when we add all the entries on the line. So let's take a look here. First of all, the investment in the bowling machine is $100,000. And notice that at the end, in year 5, we have a positive $2176. That will be the after-tax value of the salvage of that bowling ball machine. The depreciation was 5-year MACRS, which means we're allowed to take 20% the first year, and so on, and there are the percentages: 20,000, 52, 71, 20. Those are cumulative, and the actual depreciation expense would be the difference. So for instance, year 0, the cumulative depreciation is 0. Year 1, it's 20. So we take 20,000 the first year. Then we go from 20 to 52. That's a jump of 32. So we take 32,000 the second year, and so on. The adjusted basis of the machine, as depreciation goes up, the adjusted basis comes down. Adjusted basis is equal to the cost of the machine minus the accumulated depreciation. The opportunity cost there of $150,000 is the warehouse. We will charge ourselves with the value of the building at the time we start the project, and we'll recover the value of the building at the end of the project. The net working capital, we're going to start by putting $10,000 into the project, and we're going to, as sales go up, we're going to add working capital, so we go from 10 to 16, then up to 24, then we start winding down the project, and we drop from 24 down to 21 and then down to 0. The change in the net working capital then, we're going to put $10,000 in the first year, then in year 2, at time 0, year 2, we're going to put another 6, year 3, we're going to put another 8, year 4, we'll take out 3.75, and year 5, we'll take out the rest of the 21. If you add line 6, that will add up to 0. Total cash flow then, if we add lines 1 plus 4 plus 6, at time 0, we're going to spend $260,000. And then we're going to have a negative cash flow of $6.32. That's the working capital in year 2, $865 in year 3, and so on. All right. Now let's consider, let's go a little further here. Notice that let's go back a little bit. Notice that the opportunity cost of the warehouse is $150,000 at time 0, and then at time 5 we're going to recover that opportunity cost. Here's the income, sales revenue. Remember, we had $20 per unit the first year, and then the sales went up by 2% a year, and so we're going to take the number of units times $20 per unit. So $100,000 of revenue the first year. Let's look at the third year. In the third year, the value of a piece of equipment that we're selling has gone up by 2% a year, and we're going to sell 12,000 units. So 12,000 times 20.81 gives us $249,720 of revenue in year 3. Next, operating costs. If we look at year 2, for example, remember that in year 2 the production was going to be $8,000, and operating costs were $10 the first year, and they were going to increase by 10% a year. So we'll be up to $11 in operating costs in year 2. $11 per unit times 8,000 units gives us $88,000 of costs. If we look at the depreciation, we're going to use the MACRS depreciation schedule. So in year 1 we get $20,000. In year 2 we get to take $32,000. In year 3, $19,200. Now, where do those numbers come from? They're taken off IRS tables, and that's really all you need to know. You look up this bowling equipment, it's classified as 5-year MACRS property, and the IRS will tell you how much you're allowed to write off each year. If you look at year 4, the original cost of the equipment was $100,000, and we're allowed to write off 11.52% or $11,520 in year 4. So if we take the sales revenue, we subtract the operating costs, and we subtract the depreciation, we get income before taxes, sometimes called EBIT. Normally it would be EBIT, but since we have no interest, we'll just call it before taxes. The tax is 34%, just applied straight up on this, and take away the taxes, you get the net income. Now, if we take the net income and add back the depreciation, we get the operating cash flow. Or if we take the sales and take the subtract out the operating taxes, operating costs, and subtract out the taxes, and don't subtract out the depreciation. So you can either subtract it and then add it back, or just not subtract it out at all, and you get the operating cash flow. Sometimes they've referred to it as the investment after tax cash flow, IATCF. And so in year 0 we invested $260. Now this is the total cash flow of the investments, and this is the operating cash flow. And if we combine lines 4 and 5, we get the investment after tax cash flow. $260,000 in time 0, $39.80 in time 1, and so on. Now we put this into our internal rate of return formula. We take the present value of the cash flows, we subtract the cost, we get a net present value of $51,588, and since this is positive, we will accept this project. In terms of putting it into the financial calculator, here's the way you would load those cash flows. And this slide is available to you, but I'm not going to go over this slide. Inflation and capital budgeting. Inflation is an important consideration in any capital budgeting project. And we need to consider the relation between interest rates and inflation. And this relation is often referred to as the Fisher equation, or the Fisher effect. And it is this, that 1 plus the nominal rate equals 1 plus the real rate times 1 plus the inflation rate. Now, there is an approximation. And unfortunately, your textbook gives you the approximation and then proceeds to give you homework, none of which uses the approximation. But if the inflation rate and the real rate of inflation are low, you can say approximately that the nominal rate is equal to the real rate plus the inflation rate. Now, the nominal rate in the U.S. is fairly volatile, but the real rate, most economists agree, has been fairly stable historically, over time. And in capital budgeting, you have to compare real cash flows with real rates, or nominal cash flows with nominal rates. Now, where you'll get into trouble with your homework is where they give you a mixed bag. By that I mean some of the cash flows are real and some of the cash flows are nominal. And there are two ways you can approach this. You can either turn all the cash flows into real cash flows, or you can turn all the cash flows into nominal cash flows, or you can discount just the real cash flows with the real rate, the nominal cash flows with the nominal rate, and then add the two. I mentioned earlier we're going to talk about 3 different ways of calculating operating cash flow. The first is a bottom-up approach, and this will only work when there's no interest expense, and we're going to assume that there's going to be no interest expense in our projects. So the operating cash flow is equal to net income plus depreciation. The second one is second method called the top-down approach. Here we take the sales, we subtract the cost. Now in that cost, we don't include depreciation. And then we subtract out taxes. And that's the method that was used in the Baldwin Company slides that we looked at earlier. The third method is called the tax shield approach. And once again, we take sales, We subtract real cost, not depreciation. We apply the tax rate, and then we add the depreciation tax shield, which is equal to the depreciation rate, the amount of depreciation times the tax rate. Now actually, I have found that in most of your homework, the tax shield approach is the one that is most commonly used. Let's talk about projects of unequal lives. How do you look at two projects when one lasts for 3 years and one lasts for 5 years, say? Now, the big deal here, and this is where I want you to focus, if you have projects with unequal lives, and they're one-time projects, in other words, they'll never happen again, they're not going to be repeated, then it's fine to use net present value. But if you're investing in projects that are of a type where they're going to be ongoing, so that if one lasts for 3 years, at the end of 3 years, you're going to have to do it again, and then again, and then again, and another lasts, say, 5 years, then you need to adjust these two projects. If you're going to compare them, you need to adjust them so that they match up. Now, in this example, we have two choices. We have a Cadillac cleaner and we have a cheapskate cleaner. And the idea is that the Cadillac cleaner costs more, but it costs less to operate, and it's going to last 10 years. The cheapskate cleaner costs less, only $1,000 today. It has a higher annual operating cost, and it only lasts for 5 years. Now, if we were just to apply net present value to these two projects and try to compare the net present values and say to ourselves, I'll take the project with the lower net present value, which would be a cost, we would come up with the following. For the Cadillac air cleaner, we would get a cost of $4,614.46. And for the cheapskate air cleaner, we would get a cost of $2,895. It's very easy to conclude, based on that simple calculation, that we should go with the cheapskate air cleaner. It has a lower present value of costs. The problem with that is once the cheapskate air cleaner is exhausted after 5 years, we're going to have to replace it with another one. So we have two choices. We can either match these up so that the lifetimes match up. In other words, we can string together a couple of cheapskate cleaners so they match up with a Cadillac, or we can calculate what we call equivalent annual costs. So matching these up so that they line up is called a replacement chain. And we will repeat projects until they begin and end at the same time. And then we will compute the net present value of the chained project. So the equivalent annual cost method is a little different, and we'll go through an example of that. But in the equivalent annual cost method, what we do is we turn the costs into an annuity that lasts the same length of time as the life of the equipment, and then we compare those equivalent annual costs. So let's first make a replacement chain. The Cadillac cleaner will last us for 10 years, and the cheapskate cleaner will last us for 5 years. So you see what happens. At the end of 5 years right here, we're going to invest in a second cheapskate cleaner, and it'll go for another 5 years. So 2 5-year cheapskates match up with one Cadillac. And now what we can do is calculate the net present value of the Cadillac cleaner and the net present value of the chained cheapskate cleaners, and whichever one has the lower net present value is the one we will take. So the Cadillac air cleaner, same net present value, minus $46.14. The cheapskate air cleaner, if we put these chained cash flows together, you see that it has a net present value. The chain has a net present value of $46.93. So the cheapskate actually is more expensive. And the correct decision is to go with the Cadillac air cleaner. Now, for equivalent annual costs, what we do is we first convert all of the costs into a present value, and then we turn that present value into an annual cost that matches up with the original life of the equipment. So the equivalent annual cost for the Cadillac air cleaner is $750.98. We would do that by, let me just remind you, for the Cadillac, taking the $4,614 of net present value here and turning that into a 10-year annuity. For the cheapskate, let me back up some. For the cheapskate, back up even more, we will take the $2,895.39 and turn that into a 5-year annuity. And we will compare the annual cost of a 10-year Cadillac annuity with a 5-year cheapskate annuity. So just moving back to where we were, you see that the equivalent annual cost for the Cadillac is $750. The equivalent annual cost for the cheapskate is $763. And so we would go with the cheaper, the Cadillac cleaner. Okay, so here we go again. There's the Cadillac cleaner. We first calculate the present value of the cash flows. Then we turn those cash flows, that present value into a payment. So the payment is $750.98. And for the cheapskate cleaner, we convert those 5 years worth of payments into a net present value. Then we turn around and spin that net present value or that present value back into a payment, $763. And the $763 is bigger. All right, that pretty much summarizes our discussion of Chapter 8. Let's talk about a quick quiz. How do we determine if cash flows are relevant to the capital budgeting decision? Well, the big, and I kind of glossed over this, but remember, if a cash flow is there because the project is there, then it's relevant. A good way to think about this is to ask yourself this question. If the project went away, would this expense go away? If the expense goes away, once the project goes away, then that expense is a relevant incremental cash flow. If the expense is there, whether or not the project is accepted, then that cash flow is irrelevant and should not be charged to the project. Different methods for computing operating cash flow. Well, we talked about the bottom-up approach, the top-down approach, and the tax shield approach. And how should cash flows and discount rates be matched when inflation is present? Bottom line is this. Discount real cash flows with real interest rates. Remember the Fisher equation to get the real rate. Discount nominal cash flows with nominal rates. You cannot mix real and nominal cash flows and try to use some rate. No rate will work. You have to use real rates for real cash flows and nominal rates for nominal cash flows. And we talked about equivalent annual cost. And the answer to when should it be used is this. It should be used whenever you have projects that are going to have to be repeated over and over and over. Okay, that's it.